World Bank is urging Kenya's government not to rush into imposing more punitive taxes on companies in the tech and the finance ecosystem in its rush to reduce persistently high fiscal deficits that in some years have come very, very close to 10%. That at least is one of the key recommendations made in the latest edition of its review of the East African economy. But this is just part of the problem. You see, Kenya isn't meeting her own fiscal deficit targets. In 2014, for instance, the idea was to have a fiscal deficit of about 6.3% of GDP. We ended up with something much bigger, 8.1%. The fiscal year ending in June 2017 was actually the worst of the lot. The deficit in that year was over 9%. This year, the Finance Ministry has raised the deficit target twice to now stand at just over 6%. Whether or not they'll meet it is another matter altogether. So closing that deficit, at least from the government's perspective, means raising more revenue but not necessarily cutting expenditure. But there's a huge concentration risk there, and it all has to do with this number. You see, between them, telecommunications companies and financial services firms, basically Safaricom, Kenyan banks and insurance companies, they account for 6 out of every 10 shillings in income tax revenue raised by the state. So because the sector is large and relatively easy to track, it's very visible, it's been hit with wave after wave after wave of tax hikes. And this essentially gives you an idea of exactly what's happening. Just last year, excise tax on mobile money transactions was raised by 200 basis points to 12%. The applicable rate on voice, SMS and data, that went up by 500 basis points. And all of this, remember, is in addition to the 16% VAT that already is applied to those services. And who bears the brunt of these extra costs? You, the consumer. In essence, this is a classic golden goose problem. How high a tax rate is too much, especially when over 50% of jobs in Kenya are estimated to be susceptible to being lost through automation. I spoke to one of the report's authors a little earlier on, Torgusson. We started by exploring how this rising tide of taxes may constrain not just the growth of e-commerce, but also investments in and the growth of the next wave of Kenyan tech startups.
Obviously, government needs to generate revenue, but for the time being, the main target has been sort of excise fees on broadband services, on airtime, on digital financial services. Those are sort of the first step in actually engaging the digital economy. We see that especially for price-sensitive consumers, that may be the sort of the line which they're not able to cross to actually pay for those services. You're also seeing heavy disproportionate taxation on the operators themselves, whether it's regulatory fees, taxes, etc. Again, that's a good source of revenue for government, but we think we need to take a longer term and broader view. So looking at the digital economy as a whole.
Governments seem to be very keen on trying to raise as much money as they can out of this golden goose, for lack of a better word. Kenya's proposed a tax on digital transactions. That's still going through Parliament. But when we step back and look at the broad picture here in terms of the digital tax problem, what's the pain point? Are we already at a point where we can say, well, we've already taxed these guys too much, let's just stop at this point?
It's hard to see where the exact tipping point is until you've actually reached it. So I think moving with caution, I think, is the word of the day. Making sure that you're not taking actions now that are going to have a longer term detrimental impact in terms of the overall economic growth in Kenya or individuals' opportunities going forward. So it's difficult to draw a specific line where this tax is too high versus too low, and government does need to generate that revenue. But I think as a general principle, we want to try to avoid as much as possible taxing sort of the access points to the digital economy, concentrating that revenue collection downstream in terms of the resulting economic activity.
What about the cross-border problem?
So that's a key challenge, and it's something that even developed countries haven't solved yet. I know the OECD recently released a new framework for taxation of the digital economy. It's still a draft framework, but it tries to tackle this issue of firms who are offering digital goods and services but are not necessarily domiciled in that country. And the actual goods and services they're offering are hard to quantify and to assess taxation upon. So I think it's something that's going to have to happen as a regional body or even a larger grouping. Kenya can't really do it on its own. It doesn't quite have the leverage on its own necessarily to take on some of the global players, nor does it want to risk double or triple taxation if each jurisdiction is applying taxes, which then may discourage those firms from actually entering the Kenyan market in the first place.
Investors come here and they say, I have capital, I'm not seeing businesses to invest in. I talk to people in the startup space and they're saying the complete opposite. We've got ideas, but we're not getting access to capital. So there's a funding gap. somewhere in the middle here. Why does it exist? And is this an information asymmetry problem? Is it a culture problem? What's going on?
So I think it's a bit of all of the above. You're seeing both a lack of understanding on the venture capitalist side in terms of how the Kenyan market operates, and the same for the Kenyan entrepreneurs, not really understanding how to package their business propositions and their business proposals in a way that would actually attract that venture capital. You are seeing an increase in venture capital, so that is slowly starting to tighten, and you're seeing some success stories, and I hope that starts to spill over into the other entrepreneurs in that space. But fundamentally, there's a big disconnect between a lot of the sort of technical experts and people with good technical ideas, and those with actual business acumen who know to run a successful business. Maybe they don't even have a digital background, but if you can pair those two together, oftentimes that can be a much more successful venture.
Is there a taxation problem as well that stops these enterprises from growing into much larger ones? Because it seems there's a huge chunk of ideas or businesses at the idea stage and a handful of companies up here that have essentially grown, but there's a missing middle. Is that a tax problem?
In part, it's a tax problem as well. Startups typically do not make any profit for a number of years. That's the entire business model. So in theory, there shouldn't be any taxation assessed on that. But even if there isn't taxation, the bureaucratic processes are very time consuming for a small startup who's focused on developing their product, rapidly innovating and prototyping, may not have the time to actually deal with the bureaucracy. So I've seen other countries where they have actually adopted the laws and regulations and bureaucracy around that to encourage startups, creating a more permissive environment for startups to help them get to that level where they can actually grow and then generate revenue for government based on their profits.